So we've got question number 1 of part B. And in this question, if I look down, it's asked me to prepare a classified income statement at the end of March 2017. So that's a classified income statement. Now we've been given a list of accounts. Some of those will fit in the income statement, some of them won't. So, but let's have a look, we'll go through it. Anita is the owner of Arts House Business which sells pictures to tourists. Anita has provided the following account information for the year ended. So that's important. It's the year ended 31st of March 2017. Now when you're doing questions, dates are important because dates help you get the right answer, especially if you have to calculate something like depreciation or prepaid expenses, which if we have a look down here, we'll probably have. Now, so we're looking to classify these items here. Firstly, into balance sheet items. My balance sheet items are my current assets, current liabilities, non-current assets, non-current liabilities, and equity. So we need to classify those, but we also need to, for my income statement, I need to classify into income and expenses. All right. Now this becomes the more important bit because we've been asked to prepare that classified income statement. So let's have a quick look at what we've got. Now, accounts payable, where would that normally fit into?
The balance sheet.
Yeah, so balance sheet, and it'd be accounts payable is a current liability. My accounts receivable would be a current asset. My accumulated depreciation on my vehicles, well that's a negative non-current asset. My cash at bank is a current asset. My cost of sales, here's my first, this is an expense. I'll put them over this side so they stand out a little bit more. Vehicles at cost, that'll be non-current assets. Wages expense, well there's the clue, so that's an expense. Interest income, so that gives me some income. Interest expense, there's the clue again, expense. I've got inventory, that's my current assets. Got a loan which is payable in December, well that's December 2017, so that's actually a current liability. I've got marketing expenses, so it tells me my marketing expenses, so that's an easy one, that's expenses. I've got prepaid insurance, well that's normally a current asset, but it could play a little bit of a part later on. I've got rent expense, so there's another expense. I've got sales, which is my income. And I've got capital, which is equity. Okay, so I've divided the list up there, but we've been given some more information. And my more information says that prepaid insurance, so that's this one here, relates to 12 months insurance. Just here. Yeah, I'm recording this, so I can't talk to you just yet. I've got some prepaid insurance that relates to 12-month policy that was taken out on the 1st of December 2016. The prepaid insurance has not been adjusted since it has been purchased. Okay, so we've got prepaid insurance here of $3,600. Now it's telling me in this question that some of that should be expense and some of it should stay as a current asset because it hasn't been adjusted since the 1st of December. So let's do a quick calculation on prepaid insurance. I'll just do it over here. Prepaid. I've been told it's 1/3 of the year. So what have I got? I've got to the 31st of March. It's on the 1st of December. So I've got the month of December, January, February, March. So I've got 4 months. So I've got 4/12, or as someone's already alluded to, 1/3. That's okay. And I'm going to multiply it by this 3,600 here. So I'll pop my calculator on. 3,600 times 4 divided by 12 gives me 1,200 is expense. And that leaves me with 2,400 should be my prepaid insurance in my current asset. So I'm just going to highlight that so I remember. And let's look at what our next piece of additional information is. It says depreciation for the year ended 31st of March has not been recorded for for the vehicle which is being depreciated using the straight line method over 10 years. So we've got straight line method over 10 years. The vehicle was purchased on the 1st of April 2015. So now we're doing the accounts for you can't see that. We're doing the accounts there for 2017. So this being purchased in 2015 should mean that there's some accumulated depreciation which we can see up here. Okay, but I still need to calculate my depreciation for a full year. So let's see if I can calculate my depreciation. Now, straight line method, we equals my cost minus my residual divided by my life. So now the cost, where is my cost? Vehicle at cost is 50,000. So I'm just going to give this a little tick. 50,000. I go back to my additional information. It has a 0 residual value. So minus 0 divided by, and we've got 10 years of life here. So divided by 10. This means that 50,000 divided by 10 is $5,000 depreciation expense. So I'm just going to put in here depreciation expense. Now this calculation is 5,000, so I'll put a 5,000 over there. Now, what's the other thing? Sales figures include an amount of 6,000 that was received in advance for goods due to be delivered in April. Okay, so it's in advance for goods due in April 2017. So that means that my figure here, 200,000, is overstated. It is 200,000 for sales. So I have to take out, I've got 200,000 minus the 6,000 that we've got here. Means I've not got $200,000 worth of revenue, I've got $194,000 worth of revenue. Because this is not, where is it? Where's my additional? Because this is received in advance, we're going to have $6,000 of revenue received in advance, which is a current liability. So I'm just going to post over here, advance. 6,000. So if we were doing everything, balance sheet and an income statement, but we're only just doing an income statement, we'd need to know all those other pieces of information. Now we've done everything, okay, we're down to here, we've classified everything. So I'll just tick off those ones that are assets or liabilities.
I can't really fix it any further.
Yeah,
without
okay.
disrupting the class.
No worries, all right, I'll catch you later.
Okay.
All right. So 50,000, expense, inventory, loan, prepaid insurance is this one here, and this one. So I'm going to make sure I tick off everything that's here. This one can be ticked off as it's a current asset. I've got 12,000 expense there, 194,000. Okay, so now we're going to go about making our income statement. Now the first thing that I need to do, what's the first thing I need to do when I'm preparing a classified income statement? Name of the company or the heading. Now that's easy enough to pick up because it says it, where is the name of the business? Arts House. And it's for the year ended 31st of September 2017. So if you're uncertain, that's our income statement. For Arts House. Arts House, 4 year ended. What did we say? 31st of March. 2017. Now, why do you need to do that? Why do I tell you that? Because that gets you a mark. Especially this piece of information here for the year ended. So make sure you include that. I want you to maximise your marks. Okay, so let's go. First thing we put in is sales. My sales was $194,000. 194. Now the next thing I do, because it's a classified income statement, so that's important, classified income statement. What I need to do is I need to put in my cost of sales after that. So my cost of sales, less cost of sales. Yeah.
If we accidentally put less cost of sales in the expenses area,
Yep.
and we don't make it a negative, do we lose a mark?
Well, yeah, because it's technically incorrect. Yeah, so yeah, you would lose a mark if you classified it incorrectly. So I've got 194,000 minus 60,000 gives me gross profit of $134,000. 134. Yeah, that's fine. Yeah, if you wanted to bracket that figure to indicate it's a deduction, yeah, that's fine. So that gives me my gross profit, and now it is less expenses. And I want to be deducting all my expenses. Pop that up there. So I've got my cost of sales. I've got wages expense. Wages, and that was for 4,000. Now I'm just going to have two separate columns here. Oh, hang on a minute. I have forgotten my income. So let's just cross that out. Pretend we didn't do this bit. But what we need to do is add in income. Other income, which is my interest income. I should have checked. And my interest income is $2,000. So that would then give me what's called my gross profit of $136,000, being the sum of my 134 plus my 2,000. Now we go less expenses. Yeah, you can move it down. Total income, I'll leave it there. So now I've got my wages of 4,000. I've got interest expense of 2,000. What else have I got? I've got inventory, I've got marketing expenses. Marketing expenses, where did I just see that? That was there for 17,000. Okay, I've got insurance expense of 1,200. Take that one off. I've got a depreciation expense of 5,000. $5,000. Okay, and have I got them all? Oh, rent. Missed out on rent. Rent expense of 40,000. Okay, so let's see what that all totals up to. I've got 4,000 in wages, plus 2,000 in interest, plus 17,000 in marketing, plus 1,200 in insurance, plus 5,000 in depreciation, plus 40,000 equals 69,200. So that becomes my total. So therefore, I've got 136,000 here, less my 69,200. Gives me 66,800 as my net profit. Now this would be total income here. And that's gross profit up here. So, sorry, I ill-advised you there before, Sam. So, it hasn't been taxed. No, there's no tax involved in this question. Yep. All right, so that gets me my classified income statement. Now the next thing it asks is assume Anita was confused regarding the concepts of accrual accounting, because that's what we're really assessing here, is your ability to look at accrual accounting and cash basis accounting. Explain to her the major difference between the two methods. Okay, so accrual accounting, this is part B. So accrual accounting recognises income when it's earned and expenses when they are incurred. Okay, so that'll get you a mark. And cash accounting records transactions when the cash flows to or from the business. So, and that it also gets you a mark. So there is our, I'll just get it all on page. There we go.